Smart beta ETFs have gained massive attention by promising a smarter way to invest, blending the best of active and passive strategies. But are they truly an edge in your portfolio or just another investment fad? In this quick dive, we'll break down what smart beta really means, how these ETFs work, and whether they can consistently outperform the market or simply overpromise. Today we will talk about smart beta ETFs, hype or edge. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding smart beta ETFs. Smart beta ETFs are a hybrid investment approach that blends passive indexing with active strategy elements. Unlike traditional ETFs that track market cap-weighted indexes like the S&P 500, smart beta ETFs track customized indexes based on specific factors such as value, momentum, volatility, quality, or size. The term smart beta refers to strategies that systematically capture these factors to potentially enhance returns, reduce risk, or both. These ETFs attempt to overcome the limitations of market cap weighting by rebalancing portfolios according to rules-based methodologies. Smart beta seeks to exploit persistent market inefficiencies that traditional index funds may ignore. For example, companies that consistently grow earnings might be overweighted, or stocks with low volatility might be preferred. 2. Evolution and popularity growth. The emergence of smart beta ETFs was driven by investors' growing dissatisfaction with pure market cap indexing and actively managed funds. Traditional ETFs offer broad market exposure but often overweight overpriced stocks, especially during bull markets. Active funds, while seeking alpha, typically charge high fees and frequently underperform their benchmarks. Smart beta emerged as a middle way, promising a rules-based approach that could outperform traditional indexing at a fraction of the cost of active management. These ETFs gained rapid popularity after the 2008 financial crisis, when many investors became more fee-conscious and skeptical of active managers. By offering strategies that focus on factors like low volatility, quality earnings, and momentum, smart beta ETFs attracted both institutional and retail investors. Their growth is further supported by the rise of robo-advisors and quantitative platforms that seamlessly incorporate smart beta funds into algorithmic portfolio models. 3. The core smart beta strategies. Smart beta ETFs typically revolve around 5 core factors: value, momentum, size, quality, and low volatility. Value strategies target stocks that are priced below their intrinsic value based on metrics like price-to-earnings or price-to-book ratios. Historically, value investing has delivered superior returns over the long term. Momentum strategies focus on stocks with strong recent performance, betting that trends will continue in the near future. Size strategies overweight smaller cap stocks, which tend to offer higher long-term returns due to their growth potential and market inefficiencies. Quality strategies emphasize financially healthy companies with strong balance sheets, high return on equity, and stable earnings. Finally, low volatility strategies aim to reduce portfolio risk by selecting stocks with historically lower price fluctuations, often appealing to conservative investors seeking smoother returns. 4. Benefits for investors. Smart beta ETFs offer several attractive benefits that differentiate them from both traditional index funds and actively managed portfolios. First, they typically provide lower expense ratios compared to active funds, making them cost-efficient over long holding periods. Investors can gain targeted exposure to specific investment factors that have been academically proven to influence returns, such as value, momentum, or low volatility. Smart beta funds can also help improve diversification, since they deviate from the typical market cap structure that often concentrates heavily on mega-cap stocks. By using rules-based rebalancing, these ETFs aim to mitigate common biases present in traditional indexes, such as overexposure to overpriced stocks. Smart beta strategies may also offer better risk-adjusted returns by systematically avoiding certain types of market risks. 5. Potential drawbacks and risks. Despite their growing appeal, smart beta ETFs are not without risks and limitations. One of the primary concerns is factor cyclicality. No factor consistently outperforms across all market environments. For instance, value strategies can lag growth stocks for extended periods, as seen in the 2010s, while momentum strategies may suffer sharp losses during sudden market reversals. Investors chasing the most popular smart beta funds without understanding their underlying mechanics may inadvertently expose themselves to higher volatility or unintended sector concentration. Additionally, as more capital flows into specific factors, there's a risk of overcrowding, which can erode potential returns and exacerbate market swings when many investors exit positions simultaneously. Another critical issue is data mining bias. Many smart beta strategies are back-tested using historical data, which may not accurately predict future performance. 6. Smart beta versus traditional indexing. The key distinction between smart beta ETFs and traditional market cap-weighted ETFs lies in portfolio construction and risk exposure. Traditional index funds passively track benchmarks like the S&P 500, where stocks are weighted based on their market capitalization, inherently giving more weight to larger companies. This approach is simple, cheap, and widely diversified, but it can lead to overexposure to overvalued stocks or sectors, especially in late-stage bull markets. In contrast, smart beta ETFs rebalance holdings based on specific investment factors, aiming to exploit systematic inefficiencies and generate excess returns over pure market exposure. While traditional indexing assumes market efficiency, smart beta assumes persistent anomalies can be captured over time. However, smart beta's active tilts introduce additional risks, as performance depends on the chosen factor's success in different cycles. 7. Smart beta versus active management. When comparing smart beta ETFs to actively managed funds, the fee differential and investment philosophy become significant decision points. Actively managed funds rely on portfolio managers to make discretionary decisions based on market forecasts, company analysis, and other qualitative judgments. These funds often come with higher fees, limited transparency, and inconsistent performance, as managers may underperform their benchmarks after costs. Smart beta ETFs, on the other hand, apply systematic, rules-based approaches that remove human emotion and subjective bias from the investment process. They aim to capture the same potential outperformance by focusing on proven factors, but do so with lower management costs and greater transparency. While active managers may outperform in niche markets or short-term dislocations, they rarely sustain this advantage over long periods. Smart beta can offer a scalable, disciplined strategy that blends some benefits of active management without the same cost burden. 8. Final verdict: hype or real edge? Determining whether smart beta ETFs are truly an investment edge or simply marketing hype depends largely on investor expectations, implementation discipline, and understanding of factor behavior. Smart beta strategies are backed by solid academic research, and when correctly applied, they can offer improved risk-adjusted returns and factor diversification over long time horizons. However, many investors misunderstand these products, overestimate their short-term potential, or fail to grasp the cyclicality of factors. In some cases, smart beta ETFs may simply repackage traditional investment ideas under a new label, with performance that doesn't significantly beat basic index funds after accounting for fees and trading costs. Additionally, as these strategies grow in popularity, the factors themselves can become crowded, potentially eroding their effectiveness. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.